Welcome to Woods of Stardon. This is CH. I will be covering the Schroder Asia More Plus Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the Templeton Global Total Return Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. Based on the fund webpage, it seems that DBS is the exclusive distributor for the Schroder Asia More Plus Fund. This means that you won't be able to find this fund offered by other banks or platforms. So do take note if you are interested in this fund. There are pros and cons to distribution exclusivity, but that's not the purpose of this video, so I am not discussing it here. Schroders is a British multinational asset management company headquartered in London, founded in 1804 by Johann Heinrich Schroder and his brother, and grew over the last 2 centuries into a reputable financial institution providing various financial services. Schroders was public listed on the London Stock Exchange in 1959 and had several rounds of changes in its key business focus over the years. In the 1980s, Schroders heavily focused on growing its investment banking business. However, in the year 2000, Schroders decided to sell the investment banking business to Citigroup and instead turned to specialize in asset and wealth management business instead. Today, Schroders manages over 800 billion sterling pound of assets with over 6,000 employees and serves 38 locations globally. The Schroder Asia More Plus Fund is a sub-fund under the Schroder International Opportunities Portfolio Fund family. The fund family is set up as a Singapore umbrella unit trust structure. The fund is registered as a MAS authorized scheme, which means it is suitable for retail investors. The Schroder Asia More Plus Fund indicates in its webpage that the fund is managed by the Asia Multi-Asset team led by Keiko Kondo. Strangely, the descriptions cover the broad global multi-asset team instead of elaborating on Asia, and there is no manager bios provided. Morningstar indicates that the fund was initially managed by Punking Wing till 2023. Keiko was involved in the fund since 2021 till date, so there is some manager style stability in the past few years. Keiko's bios can also be found in Morningstar, where we can see she became the manager of this fund the same time when she was appointed the head of the Asia Multi-Asset Investment Team. She looks to have many years of experience managing multi-asset solutions in various organizations before joining Schroders. The Schroder Asia More Plus Fund has a pretty straightforward investment objective. As per stated in the fund webpage and fact sheet, the fund aims to provide income while seeking to achieve capital appreciation over the medium to longer term. Mentioning income first suggests it is the primary objective, while capital appreciation may be secondary. The fund is essentially an Asia multi-asset solution that is supposed to invest at least 2/3 into Asian equities and fixed income exposures. The fund prospectus provides additional details on the investment constraints. Here, it states the fund can invest in direct equities and bonds, ETFs, as well as other Schroders funds. The prospectus also provides some descriptions on the securities selection criteria. For equities, the fund will invest in stocks and REITs that offer attractive and sustainable dividends, as well as stocks that exhibit sustainable structural earnings growth to improve shareholder value. These directly relate to the income and capital appreciation objectives. Fixed income-wise, the fund has a high flexibility to invest in both government and corporate bonds in Asia, as well as Sing dollar denominated bonds globally. There are no credit rating constraints, and it is mentioned here that the fund may substantially invest in high yield or unrated bonds. Investment constraints-wise, the fund can invest max 20% in China onshore equities and onshore bonds. Otherwise, the fund is highly flexible and can invest max one-third of the portfolio outside of Asia, including commodity exposures through ETFs. The fund can also invest in other funds stated as collective investment schemes here, with no limits, as long as the resulting exposures meets the above requirements. This results in a dynamic asset allocation with no constraints on overall equity or bond exposures. The fund is designed for Singapore investors, and therefore the base currency of the fund is set as Sing dollars. It is, however, not mentioned whether non-Sing dollar exposures in the portfolio are hedged to Sing dollars or left unhedged. Given the dynamic asset allocation strategy, the fund has not defined any benchmarks, which is not ideal for investors as it makes it hard to figure out whether the fund is performing good or bad. There would normally be a typical long-term asset allocation of equities versus bonds defined for most funds, making it easier to construct an equivalent customized benchmark. It is, however, not mentioned in the prospectus here, so we will try to figure out later what we can use to compare the fund against in terms of performance. Besides the prospectus, the fund also has a dedicated featured fund page and a sales brochure. The brochure contains this allocation guideline that is actually a lot more elaborate than the prospectus. Asian equities are split into growth versus income exposures, where growth has 0 to 50% range and income has 10 to 40% range. Fixed income are also split, but into Singapore specific versus rest of Asia, where Singapore has a 10 to 40% range and the rest of Asia 20 to 60% range. The fund can invest 0 to 30% into other exposures such as commodities or non-Asia equities and bonds, and also 0 to 30% in cash equivalents. Combining all these ranges together, it means that the fund is supposed to have 10 to 70% Asia equities and 30 to 90% Asia bonds. If we take the mean of these ranges, we get 40% Asia equities and 60% Asia bonds, and can perhaps use this as a guideline for performance comparison. The brochure also provides the historical asset allocation changes for the past 3 years, including short comments, which is really good as investors can quickly understand and appreciate the active high-level changes made in the portfolio over time in response to market condition changes. Most multi-asset funds do not provide this information, so Schroders has done well for this part. We can see from here that the fund has significantly reduced fixed income exposures during this time period, in exchange for more equities and others exposures. It should be noted though that the current exposures seem to deviate from the intended ranges highlighted earlier. So this means the intended ranges are just guidelines instead of fixed constraints. The featured fund page highlights 5 key selling points for the fund. Expertise talks about the team experience that we covered earlier, although it would be better if Schroders provides more details on the team beyond the fund manager. Resilience and variety is more about the dynamic asset allocation and asset class exposures. Flexibility talks about the different share classes available that we will go through later. Singaporean indicates the portfolio has a Singapore tilt or bias, which we will see how significant it is later. The brochure, on the other hand, uses 3 key selling points instead. Expertise remains the same to cover team experience. Stability indicates the portfolio has specifically a core allocation to Singapore fixed income, though nothing is mentioned about whether there is a bias for Singapore equities. Flexibility is used here instead to talk about the dynamic asset allocation and asset class exposure. It is strange why the selling points are not consistent between the brochure and featured fund page, and I suppose not so ideal from a marketing perspective. The Schroder Asia More Fund was launched in 2020, giving it about 6 years of track record now. Fund AUM is over 700 million Sing dollars, which doesn't look too big. However, this fund is exclusive to DBS as the only distributor, and therefore all these assets are from DBS clients only. So I suppose this is a pretty decent amount. The fund fact sheet provides geographic and sector breakdown data. Geographic breakdown is good as it splits equities and fixed income exposures for better clarity. The fund currently has about 71% equities and 19% fixed income, and this is currently the largest difference in allocation between these two main asset classes since inception, reflecting a high risk on appetite for the strategy right now. Singapore exposure is about 5% equities and 6% fixed income, which is lower than what I expect for a strategy that is marketed with a Singapore tilt, especially for the equities part. The fund has significant equity exposures in Taiwan and South Korea that are the result of a high overweight in the AI chips thematic play, as seen in the top 5 equity positions, that has led to very bullish movements in these two equity markets in the past year or so. There are also some futures exposures indicated, although I can't find any further details on what they are. Sector breakdown is less useful, as it doesn't split the data into equities and fixed income exposures. At a glance, we can see there is a high concentration in financials and information technology sectors. Morningstar provides more details on this. Here, we can see the equities exposures is large cap focus with no strong tilts to either value or growth. This is despite a very high allocation of 45% to technology sector, again reflected in the top 5 positions that are all AI chip plays. Fixed income exposure wise, Morningstar shows the fund comprises of about 20% government bonds and 80% corporate bonds, with duration quite evenly spread across different time periods. On region breakdown, there is about 60% in Asia bonds, of which a large chunk are unrated bonds, which is normal for the Asia bond market. It is interesting to see a diversified global exposure beyond Asia, even though the fund is primarily an Asia-focused strategy. For the rest of the bonds that are rated, the exposures are mainly in single A and triple B rated bonds, presumably to maintain net investment grade exposure and to ensure the fixed income allocations are mainly to provide stability to the portfolio as per the fund's key selling points. The fund brochure actually provides additional portfolio information that are useful. Here, we can see the portfolio breakdown provides a nice pie chart covering the full portfolio and breaks it down further showing equity components for growth versus income, as well as highlighting Singapore bonds from other Asian bonds. The footnote also provides additional information such as equity futures exposures, shorting US Treasuries for duration management, funds and ETFs invested within the portfolio, and so on. All very useful stuff for investors to understand the portfolio better. It is therefore puzzling why Schroders doesn't integrate this information into the fact sheet. The fund looks decently diversified, with about 130 equity positions and 190 bond positions. Equities are almost all in mega cap exposures as mentioned earlier. Bonds are about 77% investment grade and 23% high yield. And I suppose this is after the fund's internal rating adjustments because it shows no unrated bonds here. The bond positions gives a 5.1 modified duration. With duration hedging implemented, the portfolio has a low duration of just 1.3 years, suggesting the fund manager wants to minimize interest rate risk. The details on portfolio yield breakdown provided is also interesting to note. We can see the fund tries to increase yields from Asia bonds exposure and others exposure, the latter covering global bonds and alternative bonds. Equity exposures, however, are not generating high yields, so the overall portfolio yield is only 3.1%. Do keep this in mind, as we will revisit this yield data when we look at share class distributions later. The Schroder Asia More Fund comes with only a few share classes, as it is distributed exclusively by DBS and therefore catered specifically to the client types of DBS. Besides the base currency Sing dollars, The fund is also available in US dollars and Aussie currency share classes only. Non-Sing dollar classes are currency hedged. A denotes retail share class, although there is also a decumulation retail share class that we will go through in a while. Accumulation and monthly distributing share classes are available for each currency type. These share classes seem to be all created at fund inception in 2020. The retail A and decumulation share classes have a management fee of 1%. Adding other expenses gives a total expense ratio or TER of around 1.2%. Up to 65% of the management fee can be paid by Schroders to DBS as trader fees. There seems to be a cheaper C share class available for Sing dollars and US dollars, with about 0.62% to 0.71% TER. I currently do not trade via DBS platform, so I am not sure what are the specific requirements for DBS clients to access this share class. Interested investors should ask your DBS client managers for more details. DBS is allowed to charge up to 5% subscription fee for this fund. Although again, as I currently do not trade via DBS platform, I am not sure what is the exact subscription fee DBS has set in their internet banking or digibank app currently. The Schroder Asia More Plus Fund provides cumulative returns chart, calendar year returns, and various time period annualized returns in its webpage and fact sheet, which is quite comprehensive. As the fund doesn't have a defined benchmark, investors will find it hard to figure out whether these are good or bad performing results just based on this data. What we can see is that the fund was incepted in the not so great COVID period, and therefore went through the market correction in 2022 that pulled down the longer time period performance numbers. It did seem to recover and delivered strong returns from 2024 onwards. The US dollar share class of the fund is currency hedged, and therefore has a slightly better return than the base currency Sing dollar share class. We will be using the US dollar share class to run some comparisons, as it is a lot easier to find Asia solutions in US dollars than in Sing dollars. Plus, most market indices are priced in US dollars. Let's try to figure out how the fund has performed relative to broad market movements. Here is the fund since inception compared to iShares ETFs representing Asia equities and Asia bonds markets respectively. Based on this time period, we can roughly split into three different market phases: the bearish market in 2021 and 2022, the flattish market in 2023, and the bullish market from 2024 onwards. Here is the bearish market phase of 2021 and 2022. The fund managed to hold up very well in 2021, outperforming both AAXJ and N6M, and lasted the year with a small positive return actually. In 2022, the fund corrected about -15%, that is similar to N6M and much better than AAXJ. There is definitely some clear downside or risk management at work here, adjusting the portfolio probably to overweight in bonds and cash, while minimizing equities in order to achieve this. Flattish market phase like the year 2023 is typically a difficult time for active fund managers, as they struggle to make sense of market movements and changes. We can see the fund seems to have increased some equity allocations through the higher correlations to AAXJ, although it ended the year with marginally lower returns than AAXJ and both trailing behind N6M. For the bullish market phase from 2024 onwards, the fund clearly has even more equity allocations with even higher correlations to AAXJ. We also know this as a fact from the historical asset allocation chart provided by the fund that we went through earlier. It is interesting to note, however, that if we try to create a simplified asset allocation of 60% AAXJ plus 40% N6M, we would have gotten 56.27% returns for this time period, which is similar to the fund's performance. Looking at the more recent one-year chart, where the fund has adjusted its allocations to even more equities and less bonds, we can similarly replicate the performance using 70% AAXJ plus 30% and 6M. This calculation suggests that while the fund has been making the right asset allocation decisions over time, the underlying stocks and bonds selection didn't seem to have provided much alpha returns on top of what the asset allocation changes provided. There are not that many Asia multi-asset funds with Sing dollar share classes available in the market. Here are some that I found, and it is quite clearly shown in this chart that Schroders Asia More Plus has had a much better performance that is mainly attributed to its lower drawdowns in 2021 and 2022. Looking at the bullish market phase from 2024 onwards, we can see Schroders Asia More Plus is not the most aggressive in capturing market upside, although it is still pretty decent. The Schroder Asia More Plus Fund markets its three types of retail Sing dollar share classes as investment choices for investors depending on their objectives. It is clearly stated that the A distributing Sing dollar class has a target distribution yield of 5% per annum, while the decumulation distribution Sing dollar class has a target distribution yield of 6.88% per annum, and with the expectation for its capital to be reduced over time. Let's go through the historical distributions first. The fund does provide the full distribution history in its webpage that can be downloaded as an Excel file. From here, we can see that the distribution amounts are not fixed, and with small variations each month. There is no associated NAV for each time period though, so it is difficult to calculate the percentage used from this table. Morningstar provides the data we need. Here, we can see both the NAV and distribution amounts for each month for the past 10 months. A quick calculation finds the A distributing Sing dollar class has around 0.41% yield per month, translating to around the 5% per annum target yield. The decumulation distribution Sing dollar class similarly has around 0.57% yield per month, translating to around the 6.88% per annum target yield. There are minor variations to the percentage each month, but this is usually the best a fund can do if it wants to try to provide a fixed yield percentage instead of a fixed yield amount. It therefore seems that the fund has been faithfully keeping to its target distribution yields so far. Let's do some simple return estimations. Asia equities as represented by the MSCI AC Asia ex-Japan Index historically generated about 9% per annum, while Asia bonds as represented by JP Morgan Asia Credit Index historically generated about 4% per annum. If we use this as a basis, a 50 equities 50 bonds portfolio should generate about 6.5% per annum in the long run. If the portfolio is taking out 5% for distribution income, there would be only about 1.5% per annum growth in the capital. If the portfolio is taking out 6.88% for distribution income, there will be a slight capital decline. A 60-40 or 70-30 portfolio would be able to sustain the 6.88% distribution income better with lower potential impacts to the capital. But that's all hypothetical long-term average returns estimation. If we look at the actual historical returns of the fund, we can get a better feel how the NAV or capital ended up in good years and bad years. For example, 2022 was the worst year on record with the fund delivering a minus 15.08% total return. Taking out another 5% distribution means the NAV was actually down minus 20.08%. Taking out 6.88% distribution alternatively means the NAV was actually down minus 21.96%. Similarly, in the best year of 2025, the fund delivered a 13.42% total return. Taking out 5% distribution means the NAV was actually up 8.42%. Alternatively, taking out 6.88% distribution means the NAV was actually up 6.54% only. While having the decently high income payout feels good, investors do have to be prepared to see these net NAV returns in the statements, knowing that these are the remaining capital that goes on in the next year. Consequently, here is the total return versus NAV chart since inception for both the 5% and 6.88% distribution Sing dollar share classes, showing NAV growth for both have been minimal. With that, let's summarize our findings. Schroders is a UK-based global asset management firm with a long heritage and with a broad product offering totaling over 800 billion sterling pound of assets. The Schroder Asia More Plus Fund is an Asia multi-asset solution launched about 6 years ago. While it is a product distributed exclusively by DBS, it has managed to garner over 700 million Sing dollars of AUM, which is a decent size. The fund is managed by Keiko Kondo for the past 5 years. She leads the Asia multi-asset investment team in the firm. Schroders markets the fund with a few key selling points, one of which is the dynamic asset allocation model that seems to have been working out well, especially with reduced drawdowns in poor market conditions such as 2021 and 2022. This has helped the fund outperform its peers in the long run. On the other hand, the fund has delivered decent but not outstanding performance in bullish markets. It would help if the market upside capture can be further improved, or if there are clear and visible alpha returns coming from underlying securities selection. Another key selling point is a supposed Singapore tilt in the portfolio. However, with only 5% Singapore equities and 6% Singapore bonds in the current portfolio, this is hardly a significant allocation. The key selling point of the target 5% and 6.88% distribution share classes are pretty well explained in the fund materials. I do find this yield percentage a bit too high, as capital needs to be used to supplement the underlying portfolio yield. The decumulation share class, by design which I dislike, has capital decline expectations in order to sustain the high 6.88% distribution. In conclusion, the Schroder Asia More Plus Fund is a decent Asia multi-asset solution, especially with its dynamic asset allocation that has proved to work so far, in particular during poor market conditions. Investors do need to understand the consequences of the high distribution share classes. While this is a DBS exclusive product, most of the Singapore investors should already bank with DBS, and therefore product accessibility is not a big problem. This concludes my absolutely biased comments on the Schroder Asia More Plus Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.